Good day to Dr. Jaspal. I'm Amin, and today my group and I will be presenting on our financial analysis of Berjaya Food Berhad, or as we call as B Food, the company behind Starbucks Malaysia, Kenny Rogers Roasters, Paris Baguette, and the list goes on. And today we'll be looking at what we call as Brewing a Crisis, a financial analysis of Berjaya Food Berhad. So BeeFood is listed on Bursa Malaysia and run three main brands. Starbucks Malaysia is by far the biggest part of the business. Now it makes up 87.5% of the group revenue. Now this matters a lot because in the annual report of 2025, Starbucks stores in Malaysia were hit by consumers boycott linked to the Middle East conflict, as we know, related to the Palestine and Israel case. So this one event set off a chain reaction. Now it hurts revenue first, then profit, then the whole balance sheet altogether. Now, this is the story that we will walk through to you today. So, Doctor, today our presentation will be divided into four parts. First, we will look at the financial position, how healthy the balance sheet is. And then, second, we will look at the financial performance, why the profits fell so much after the case, and a lot of other things. Third, we will look at the financial outlook, what might happen next. And finally, we'll give our recommendations for how BeeFood can actually recover. Now, I pass it over to Hadi to talk about the first part, which is the financial position.
So let's start with liquidity. Can Berjaya Food pay its short-term bills? The answer is barely. So for every 1 ringgit Berjaya Food owes in the next 12 months, it only has 23 cent in the current assets. So that is the current ratio at 0.23 times, well below the safe range of 1 to 2 times. So the quick ratio and the cash ratio tell the same story. They are also far beyond what is considered safe. So, in total, Berjaya Food has a working capital deficit of 510.2 million ringgit. So, in simple word, the short-term debts are much bigger than what the company can quickly turn into cash. So why this is happening? There are two reasons. The first one, the short-term borrowings of 281.7 million ringgit plus lease payments of 58.3 million ringgit that make up more than half of all current liabilities. Second, even though operating cash flow was positive at 76.1 million ringgit, cash still went down by 4.2 million ringgit overall because of other cash outflows. So next is solvency. Can Berjaya Food survive long terms? Shareholders' equity fell at 72.5% from 392.5 million ringgit to just 107.8 million ringgit, mainly because of a large net loss and impairment chain charges. So at the same time, the debt to equity ratio jumped from 2.61 times to 8.49 times, and the gearing worsened from 1.89 to 5.41 times. So this means creditors, not shareholders, now carry most of the risk. Worst of all, the interest coverage flipped from a safe 1.44 times to negative 5.74 times. So the company operating earning can no longer cover its interest payments. To sum up the position, Berjaya Food has three connected problems: a liquidity shortfall, rising leverage with shrinking equity, and a failure to cover interest payments. So these three issues are not separate, they fit into each other.
Thank you. My job is to answer one simple question. Is Berjaya Food good at turning sales into profit? And does it use its assets well? I look at these three ways: the trend over time, where each ringgit goes, and the key ratios. Let's start with the big picture. We begin here at 750.7 million ringgit of revenue. Then sales fall 36%. That is 271 million ringgit, gone in just 1 year. But watch closely. The next two bars, cost of sales and staff costs barely move. And right here, after SG&A, the business drops below zero. This is the exact point where the loss begins. The final result is a net loss of 288 million ringgit, more than three times bigger than the year before. So why did the loss get so big? This slide shows the answer. Here, every cost is shown as a share of sales. The red line is 100%, that's your total sales. Anything above that line is a loss. Look at last year. Costs were already above the line. 1 ringgit and 2 cents of cost for every 1 ringgit of sales. This year, it got worse. 1 ringgit and 20 cents of cost for every ringgit earned. This reason is simple. Sales fell 36%, but staff and rent costs fell only 14%. You can't cut rent when customers stop coming, so these fixed costs ate the profit. Now, one honest point about that big loss. The reported margin looks terrible, negative 60%, but it includes a one time charge of 161.9 million. That's the company writing down the value of store it closed. It's on paper, no cash actually left the business. So let's take it out. Without it, the margin is a negative 26%, better than 60, but still a loss and four times worse than last year. So this one-off charge make the year look worse. It did not cause a problem. The core business was already losing money. The efficiency ratios tell the same story. Every ringgit of assets used to bring in 53 cents of sales. Now it brings in only 47. The clearest sign is inventory. Stock now sits 69 days before it sells, up from 56. For a food business, longer waiting means higher risk, spoilage risk. One honest note, the receivables number mixes in some non-trade items, so the level looks higher than it really is, but the direction is still clear. Everything is slowing down. So let me bring it together. Four things: sales, profit, debt, and speed. All four move the wrong way in the same year. That tells us this is not one bad quarter, it's a deeper structural decline. And one cost runs through all of it: a much smaller business. Carrying costs it could not shrink. As losses ate into the company's own money, its debt level climbed sharply, turning an operating problem into a balance sheet problem. And that is exactly where my fellow groupmates take over, looking at the debt, the cash flow, and the risk ahead. Thank you.
Thank you, Kalok. Now, let's talk about efficiency and benchmarking. Now, BeFood's cash cycle is based on three measures, as you can see on the screen: inventory days, receivable days, and of course, payable days. Now, this results in a cash conversion cycle, CCC, of 170 days. A negative CCC may look positive at first. However, in the case of the company or the business, it is mainly because the company takes a very long time to pay suppliers. As you can see, it takes about 267.5 days, which is more than 9 months. So this suggests that BeFood is relying heavily on supplier credit to support its cash flow, which also indicate that cash flow pressure rather than strong cash management. Now let's talk about the key risk: concentration risk. As you can see from the figures, BeFood's revenue comes from Malaysia alone, which is 96.3% of the group's revenue. And within that, Starbucks alone makes up 87.5%. Kenny Rogers, Paris Baguette, and other markets are only a small slice from the pie chart. Now, this is risky because one brand in one country can shake the whole company. And that is exactly what happened in 2025, as reported in the annual report of 2025. You can see on the right, it started off with a consumers boycott linked to the Palestine and Israel case. And then, because Starbucks is so dominant, it hit Starbucks outlet and then led to revenue collapse, dragged down the operating margin, and finally weakened the whole balance sheet. Now I'm going to pass it over to Dr. Alex to talk about the next part.
It's my turn to present our 5 years completion of Berjaya Food Berhad. Our compilation is focusing on the intra-sales ability and his competitive position. One of the important findings is the weaker working capital efficiency. The cash conversion cycle increased from 7.1 days in 2022 to 25.1 days in 2025. In particular, inventory days is more than double. It's increased from 37.6 days in 2022 to 76 days in 2025. Put simply, eventually it's taking more longer to be sold and converted into cash. As a result, more cash is locked in the store, increasing the company reliance on the external funding. Besides that, Berjaya Food ability to serve interest has been weakened sharply. Both EBIT and EBITDA interest coverage was longest during 2022 and 2023, showing that the company have the strong capacity to meet its financial costs during that period. However, the performance deteriorated after 2023. By 2025, EBITDA interest coverage has fallen to only 0.7 times. A ratio below one time is a major concern because it means that earnings are insufficient to fully cover interest expenses. This reflects pressure from weaker operation margin and rising the digital later challenging. Therefore, the company faces a higher financial risk if profitability and cash generation did not perform in the future. For the external competitor analysis, it is important to clarify that there is no external company is a fully appropriate financial benchmark for Berjaya Food. Although the companies such as Oriental Coffee, Juice Coffee, GG Coffee, Mary Blau, KFC, Secret Recipe, and Big Talk operated in the related food and beverage market, but their business model are different. For example, the Juice Coffee and GG Coffee are newer digital driver coffee concept, while KFC and Many Bar focus mainly on fast food. Secret Recipe and Brady Talk operated primarily in bakery and casual dining, where Oriental Coffee is more focused on the local coffee time style dining. These businesses are different in product, mix, pricing, customer segment, outlook format, skill, financial arrangement, supply chain, and cost structure. Therefore, they can provide a quality insight such as customer trend, operation efficiency, digital engagement, and inventory management, but they should not be used as a direct financial benchmark for Berjaya Food. A direct combination of liquidity or interest coverage could be misleading because the underlying operations are not sufficient comparable.
So, what happens next? There is some good news. The large impairment was mostly a one time accounting charge, and it is unlikely to repeat at the same size. BeFood also has a brand recovery program, digital loyalty push, and new geographic expansion underway. But the risks are still serious. The working capital deficit of 510.2 million ringgit has not gone away, and 281.7 million ringgit of short term borrowings need to be refinanced soon. Overall, the outlook is improving operationally, but the balance sheet is still fragile. Based on all of this, we recommend three things. First, fix the balance sheet. Refinance the 281.7 million ringgit short-term debt into longer-term loans and pause dividends until the current ratio and gearing improve. Second, fix operations. Tighten working capital discipline to shorten the cash conversion cycle and shift new store growth toward an asset-light franchise model, which needs less upfront capital. Third, fix the concentration risk. Set clear recovery targets for the Starbucks brand, such as footfall and loyalty signups, and speed up expansion into new markets so the group is not so dependent on one brand in one country. To conclude, BeFood's current ratio of 0.23 times, gearing of 5.41 times, and negative interest coverage of 5.74 times all point to the same conclusion. This is a company under real financial pressure, not just a one-year dip. The path forward has three steps: restructure the balance sheet to reduce leverage, restore operating profitability through better cost and working capital discipline, and diversify away from its heavy reliance on Starbucks Malaysia. This page contains the reference used in this presentation, and this concludes our group presentation on the financial analysis of Berjaya Food Berhad. Thank you.